The 30-year fixed mortgage rate hit 6.55% today, up 6 basis points from last week's 6.49%, according to Freddie Mac's weekly survey released through Fred. 6 basis points sounds like rounding error. It isn't. Mortgage rates are the central affordability lever for American households. They set monthly payment sizes, determine loan qualification thresholds, define whether refinancing makes financial sense, and ultimately decide how much of the buyer pool can even access the market. When this number moves, the entire housing ecosystem, builders, originators, home improvement retailers, moves with it. To put today's number in context, you need the arc of the past 3 years. In late 2023, the 30-year rate climbed above 7%, its highest level in over 2 decades, as the Federal Reserve's aggressive rate hiking cycle drove Treasury yields sharply higher. From mid-2024 through 2025, as the Fed shifted to cutting rates, mortgage rates trended lower and gave buyers a gradual affordability tailwind. Today's 6.55% print suggests that tailwind has faded. Rates are no longer falling, and as of this week, they are ticking back upward. Here's the mechanism. The 30-year mortgage rate prices off the 10-year Treasury yield, the benchmark for long-duration U.S. lending, plus a spread that reflects lender competition and secondary market demand for mortgage-backed securities. The 10-year Treasury yield stood at 4.62% as of July 13th. Today's mortgage rate of 6.55% implies a spread of approximately 193 basis points above that benchmark. That spread has been historically wide in recent years, which partly explains why mortgage rates haven't fallen as fast as the federal funds rate has. The secondary market for mortgage bonds hasn't fully normalized. What's driving this week's specific move? Markets are trimming expectations for near-term Federal Reserve rate cuts. The federal funds rate currently sits at 3.63%, and the Fed has been in a wait-and-see posture. With unemployment at 4.3%, the labor market remains solid, not the kind of weakness that forces the Fed's hand. Inflation, as measured by the Consumer Price Index, remains elevated relative to the Fed's target. When traders scale back cut expectations, Treasury yields edge higher and mortgage rates follow. That is the transmission chain driving this week's tick upward. The real-world impact lands in housing. At 6.55%, the refinancing incentive is essentially absent for the large cohort of homeowners who locked in rates below 4% before 2022. Those borrowers have no financial case for refinancing at today's rates. And since selling a home typically means surrendering that low-rate mortgage, they are not listing their homes either. The result is a structural inventory shortfall. Fewer existing homes come to market, supply stays tight, and transaction volumes across the chain stay depressed. New construction has partially filled the gap, but builders have had to offer rate buy-downs and price concessions that squeeze their margins. For equity markets, the rate-sensitive names carry the most direct exposure. Homebuilders, Lenner, Polt Group, and Toll Brothers see buyer qualification thresholds shift with every rate increment. When monthly payments rise, fewer buyers qualify for the same-priced home, order books slow, and builders face pressure to cut prices or subsidize mortgage costs out of their own margins. Rocket companies, whose revenue is heavily tied to origination and refinancing volumes, faces a market where neither side of that equation is generating strong throughput. Home Depot and Lowe's feel the downstream drag. Home purchase activity drives big-ticket renovation spending, and lower transaction volumes constrain demand in their highest margin categories. The key watch item from here is the 10-year Treasury yield. At 4.62%, it is holding well above the levels that would allow mortgage rates to ease meaningfully. If upcoming inflation readings surprise to the upside, or if labor market data stays firm, the Fed's pause extends and yields hold elevated. A sustained move back towards 7% on mortgage rates would represent a significant affordability shock for a market already running on limited inventory and compressed demand. Conversely, any softening in economic data that revives cut expectations would relieve the pressure. The housing market's near-term path runs directly through the bond market.